Hey guys, alright, so it's been a while since my last blog post. I actually spent a week updating a lot of my models, trying to get better acquainted with how the Greeks move with the different strategies. So I'll start with the daily trades again tomorrow. But just for the weekend, I just wanted to go over some stuff that I'm seeing in the market here. We said last week that we expect a little bit of a rally in July, and we're getting it. Next week is going to be a big week, or this coming week. We have a lot of the mega cap tech names reporting earnings. We have a Federal Reserve interest rate decision. So all that stuff is going to probably add some volatility in the market in the coming week. Also, one other thing I wanted to show you here. If you take a look at the S&P 500, I'll go over this chart in a minute, but come down here to the Bollinger Bands. You see how they're getting pinched right here? It's leading me to believe that there's going to be some type of big movement to the upside or downside. We don't know, but with the pinch in the Bollinger Bands here, I'm expecting some more activity, some more volatility in the coming week. I wanted to go over this chart here. This is actually, let me blow this up a little bit. So this here, the gold line here is the copper to gold ratio, and this is a good indication of where we are in the economy, right? So you would expect copper to drop if we're going to enter a recession, or rally if we're going into expansion, and you would expect the opposite of gold. Gold is going to rally when things are looking weaker, and then they're going to sell off when things are looking better, especially during an inflationary environment as a hedge against inflation. So you can see here that ratio has started to drop off, and what we're seeing here is just the 10-year Treasury yield scale to the left. And we're hitting some points of resistance here. So I'm thinking that the 10-year yield can start to come down a little bit over the coming weeks. Again, depending on what the Fed says tomorrow. But that could actually prove to be a tailwind, a further tailwind for equities to move a little bit higher. And with that tailwind from the decline in the treasuries, you would expect the growth names to outperform the value names. And that's basically what we're seeing here. This guy's saying growth has underperformed value substantially since the start of the year, but recently it's been improving. So I do expect a little bit of movement in the higher growth names. Very tactical. I don't expect it to last, but I do think there's a certain level we can hit in the S&P 500 that would make sense. This here is the chart. I think I had this chart on last week. This is basically month by month market performance during a midterm election. And you can see, this is what kind of our case, is that July tends to be pretty good heading into it, and then August and September tend to be really weak. So whatever short-term move higher we're getting now, there are certain resistance levels that I think we can hit, and then from there, I think we can see a pretty aggressive sell-off, maybe even back down to the lows that we saw earlier in the year. I'm going to start with this monthly S&P 500 chart. So you see in previous recessions, there's a pattern, right? I went over this last week. The MACD histogram goes negative, and that happened for us. Then we get a breach below 50 on the RSI 14 and a breach below the 20-month moving average. So you can see here, yeah, we did breach 50 to the downside, and we did breach the 20-month moving average to the downside. So next, I'm expecting this 20-month moving average to roll over and start sloping negative. So we're not quite there yet, but we will be. Then what will happen is the market would come back up, retest this 20-month moving average, and then from there you get the continuation sell-off that you see here in the red spots, here and here. So there definitely could be additional downside to the market if we're heading into a recession. So this recession is going to largely be driven by the Federal Reserve having to combat inflation. So you can see here, this is the returns after the S&P fell 20% from a previous record. And you can see right here in the 70s and the 80s, this is really 1982, not 1987, but figure 1970, 1973, 1982. You can see that 6 months later, the market was flat to down. So I think this kind of correlates with our story. As the Fed has to fight inflation, the economy is going to move into a recession, And I certainly think that this is not going to be a V-shaped recovery. It's going to be more of a W. It's my strong opinion that we'll be retesting the lows that we saw earlier in the year. So yeah, we're waiting to see if this on the monthly chart, the S&P could climb up and reach this 20-month moving average. On the weekly chart here, I think key level to watch is going to be this 20-week moving average, around 4,100. You got the 50. This is the 50-week up here, around 43 and change. That seems like a bit of a stretch, but certainly on a weekly basis, I see that 41 level being a tough spot to breach to the upside. So let's put this all together. This is what the market looks like. This was that head and shoulders formation. This is your neckline. So you can see the neckline is sitting right in here at 4150. 4350 to 4360 is that 50-week moving average. That's this purple line I was talking about, which also corresponds with the 200-day moving average. But this seems like a stretch. I don't think we're going to get all the way up there. But if you take a look at that 4230, that's the 20-month moving average that we just discussed on the monthly chart. So that's sitting right here, right? 4230. The 4150 is the March lows and the June highs. So again, right around this 4200 level. The 20-week moving average is right here. This very bright green. So again, sitting right around that 4150 range. So yeah, you can see that there's a lot going on here. 4100, 4150, maybe 4200, where I think that's where if the S&P does make it up to these levels, I think there's going to be so much headwind up there that it's going to be very, very tough to penetrate. The good thing is, though, is we did break through the 20-day moving average, which is now sloping higher, and we also did manage to get through the 50-day moving average last week, even with the sell-off that we got Friday. So I'm looking for a further advancement up to maybe 4100 to 4200, somewhere in this range, probably the 4150 level, and then from there I think we could see a subsequent sell-off. Other levels we'll be watching here, so the 50-day and the 20-day. So that 50-day moving average up here around 39.19, and the 20 days 38.86. Those have to hold. If in the next couple of days and weeks, we start breaking through these, I think we can see some further downside. And again, I think the drop dead number here is around this 37, which represents the lows that we hit in July. So we're at a tricky point here. I'm anticipating a little bit more of a rally heading higher. But again, if we were to make it to this 4150 range or so, I would definitely get aggressive and start putting some downside protection into the portfolio. If we break below the 37, same thing. Get aggressive with putting downside protection in. So we're just going to wait and see what the market dictates us to do. So why do I think we're going to be heading lower? Because I do think we're heading for a recession. I thought this was pretty interesting. This is copper prices to job openings. Pretty tight correlation, I guess, on the surface of it. But you can see here the price of copper has just come in so hard. And I guess with a lag, you would expect to see job openings also start to come in. So it's leading me to believe that the economic data that's coming out is going to start to deteriorate as we get into the next days and weeks. So we spoke about earnings. The earnings season so far, this for the second quarter, is not turning out to be that great, right? So this is from FactSet. They're saying 21% of the companies in the S&P 500 have reported their actual results. Only 68% have reported results above their estimates, and that's below the average of about 77%. So companies are beating, or less companies are beating, and they're beating by less. The average company reporting 3.6% above estimates, which is below the 5-year average of 8.8%. So there's less companies beating, and those companies that are beating by a much smaller margin. So not a great sign for earnings to come. And in terms of earnings growth, we haven't really seen estimates come down for future growth. I mean, this is largely carried by the energy sector, right? So the quarter-over-quarter earnings for energy are just carrying the entire sector, it seems. But I certainly think that as we progress into the earnings season a little bit further, you're going to start to see negative pre-announcements. You're going to start to see cuts in earnings, and I think that's going to be it's definitely going to be a headwind for the market. Revenues also are coming in very weak, right? In terms of revenues, 65% of the companies that have reported actual revenues above estimates. That's below the average of 69%. And the revenues are beating by 1.3% on average versus 1.8% on average. So yeah, less companies are beating their top line number, and those companies that are beating it by a much smaller margin. So again, not a great sign for earnings on the horizon. Why is that important? Because if you take a look at, so this is from Lance Roberts, RA Advice, and he put up this nice, so this is the S&P 500 CAPE, and even with the decline that we had in the market, earnings haven't come down as much, so the valuations have become a little more reasonable. But what the case, what he's saying in the case we've made here is that looking at the forward earnings at least, it's not really reflective of the coming recession. So those earnings are going to have to come down. So we're just looking at valuations here. So he's looking at the valuation going back in time. This is on trailing earnings, the CAPE. I think they go back 10 years. But you can see here the range, the high, the low, and the average. And even with the sell-off that we had recently, we're still above this upper band, which means that as earnings start to come down, the stock market's going to need to come down to better reflect a better valuation. I think he was saying here that the S&P would need to fall to 2647. It's down an additional 32% just to reach the long-term average. This is RB Advisors. They come out with a blog newsletter, and this person just said that we're not really, when you're at a low and you're hitting that capitulation, there's just different characteristics of the market and the economy, and we're just not seeing it, which is making the case that we haven't seen the worst of this decline yet. I tend to buy into it, but his points are valuations are still elevated. We just saw that. Wall Street is pretty neutral on stocks. So analysts are, they don't have that fear. They're not pulling everything out of stocks, and really that's a reflection too of retail investors and other investors who just throw their hands up and say, I've had enough, get me out, but, I don't want to lose any more money. And we're not seeing that type of fear in the market just yet. Analysts are the most bullish in a decade. He's saying in terms of ratings on stocks, 57% have buy ratings versus 53% on a 5-year average. So analysts have not started to bring their earnings estimates down yet. They haven't started cutting price targets. They haven't started downgrading stocks. So I think that's also on the horizon. Traders aren't panicking. You can see by the VIX. Here's the VIX, right? And usually the panic area somewhere north of 25, and we're trading at 23. So given where we are in the economy and given the headwinds that we're most likely going to be facing as the year comes to a close, they're saying that there's just a lot of complacency as measured by the VIX. But what's interesting here, I'm just seeing this, is that if I draw a little bit of a trend line here, you can see this thing is probably due for a bounce higher, which would mean a drop for the stock market. Bubble stocks still dominate portfolios and headlines. Some stocks out there are down 80, 90% from their peak. It's crazy. So he's writing here, he's saying here the last tech bubble we had, tech and telecom stocks went from representing 41% of the S&P 500 all the way down to 16%. So, tech and telecom just got crushed in the bubble, whereas now they've gone from 40% representation down to 37%. So still too much froth in the high growth names. Households, U.S. households equity allocations are still near record highs. So the average investor, the retail investor, they're not pulling the plug and saying, get me out. I got to stop losing money. There's not that blood in the street and that panic that we're seeing at a major capitulation low. And he's saying here that investors are still buying. According to Bank of America, their client equity flows actually accelerated last week to $2 billion. So people are actually putting more money to work in the market. So this isn't indicative of a major market bottom, is what I'm trying to say. Earnings are going to come down. The economy is going to start to deteriorate. I do think there's one more leg lower for the market. There's going to be some capitulation, and then from there, we can hopefully start a new bull market. This was interesting. It's from Doug Cass. He's good stuff. So I think this was from BTIG. S&P 500 got up to 4,012 on Friday, a few points shy of the unfulfilled gap of 4,017 and 10% off the recent lows. Our view remains that it's prudent to reduce risk above 4,000 as we are still in the confines of a bear market. While we saw the most amount of 4-week highs since March, the paradox here is that the last 2 times we saw this amount of 4-week highs, it signaled an exhaustion of the rally. From a seasonal perspective, over the past 30 years, August has been the worst performing month for the S&P 500, with September not much better. Don't get fooled. I do think there could be some additional upside. I think there's a lot of headwind up there, and just given the seasonality and where I think earnings are going to be coming to, and just what the new economic numbers will show, I do think there could be another aggressive leg lower come August or September. So we have to prepare for that. Here's this, I saw this is all about the 50-day moving average. So as I mentioned last week, we did penetrate the 50-day moving average to the upside on the S&P 500. So he's writing, as of Thursday's close, 57% of the S&P 500 members were trading above their 50-day moving average. And that's up from mid to 5% back in June. So a big recovery. And so in a month, about half of the S&P 500 stocks have gone from being below their 50-day to above their 50-day. And he's asking, is that sustainable? And he goes on to throw some of these numbers out, which I thought were interesting. Starting in August 2021, most rallies have stalled out when this indicator has reached 70%. So we're at 57. So again, kind of going to my tactical trading plan, that we could see some additional upside, but not much more up to the levels that we spoke about. We saw that in August 2021, in November 2021, in January 2022, in March 2022. A couple other bear market rallies saw this indicator rise only to around 50%, which was March 2022 and June 22. So the March rally may be a good parallel to what we're seeing now. So basically getting into that, we broke the 50-day moving average to the upside. We have about half the companies in the S&P trading above their 50-day moving average. But in the past, this hasn't acted as an indication of the market bottom. It's actually indicating that we might be stalling out here. This rally might be getting a little tired. So just keep that in mind. And this is, I don't know about this, but this guy says that after hours on Friday, big money snuck millions of dollars worth of puts on the SPY, which is a hedge against the portfolio. So I guess there's some big money out there putting in some downside protection ahead of what's going to be a really big week. It makes a lot of sense, right? We got all these corporate earnings for the big tech names coming out. We got the Federal Reserve next week. I showed you the pinching of the Bollinger Bands, which indicates that there's going to be some volatility on the horizon potentially. So it looks like someone here is kind of hedging their bets. Yeah, so that's where we are. We could see some additional upside as we head into August. Again, I think this 4,100 level to this 4,150 level is going to be just about where the market can go without running into major headwinds. So maybe we'll see an additional 3.5% to 5% upside from here. And then from there, I think you can get a pretty aggressive sell-off come August, September, maybe even into early October. Maybe even down here to the 3,500 level to kind of retest the lows or even fall below the lows. Yeah, if you take a look at 3,500, that represents, this is the 50% Fibonacci retracement from the lows we hit in 20 up to the peak. And it also represents the 200-week moving average. So 3,500, a very sharp, sudden, call it 6 to 8 week sell-off from our level up here, 41 to 4150. If we make it, I think we can easily see it break new lows. And I would say that 3,500 level is going to be very important to watch. Speak to you soon. Thanks.